As of April 8, 2025, the Federal Reserve Fed has maintained the federal funds rate at 4.5% following its March meeting. However, recent developments, particularly the implementation of extensive tariffs by the U.S. administration, have introduced significant economic uncertainties that may influence the Fed's monetary policy decisions for the remainder of the year. JPMorgan, impact of new tariffs on the economy. President Trump's administration has enacted sweeping tariffs on imports, leading to considerable market volatility and raising concerns about a potential economic slowdown. These tariffs are anticipated to disrupt global supply chains and increase production costs, which could contribute to higher inflation and dampened economic growth. Reuters, recession risks and Fed's potential response. In light of these developments, financial institutions have adjusted their economic forecasts. Goldman Sachs, for instance, has raised the probability of a U.S. recession to 45% and now anticipates that the Fed may initiate interest rate cuts starting in June 2025. Their revised outlook suggests a total of 130 basis points in cuts by the end of the year. Similarly, JPMorgan projects rate cuts commencing in June, with reductions at each subsequent Fed meeting throughout 2025, potentially bringing the upper range of the federal funds rate down to 3%. Fed's stance and economic indicators. Fed Chair Jerome Powell has expressed caution regarding premature rate cuts, emphasizing the need to monitor economic indicators closely while the Fed aims to manage inflation and support employment. The current economic climate, marked by tariff-induced uncertainties, complicates policy decisions. Former Fed Vice Chair Alan Blinder noted that if the situation develops into a recession, the Fed would likely respond with rate cuts. Reuters. Market expectations and investor sentiment. Market reactions reflect these concerns, with significant fluctuations in equity markets and adjustments in bond yields. Investors are increasingly factoring in the possibility of earlier and more substantial rate cuts, as evidenced by movements in Treasury yields and futures markets. Reuters. Conclusion: given the current economic landscape, influenced heavily by new tariff implementations and resulting market volatility, there is a growing consensus among economists and financial institutions that the Federal Reserve may begin cutting interest rates in 2025, potentially as early as June. These anticipated cuts aim to mitigate recession risks and support economic stability amid ongoing uncertainties.